when I accepted the kind invitation from the CFA Society Ukraine to come and speak about GIPS, I was thinking about, in general, the education that can be supplied by a group such as the CFA Institute, not just around global investment performance standards, but codes of conduct and guidance in general, both for trustees and for asset managers. And we have within the Institute a range of resources that are available that speak to these issues. And I've expanded my talk a little bit to just touch on asset manager code of conduct and some trustee information as well, because a lot of what's been mentioned today has encompassed the concepts of the need for education and the need to understand what it is that people are receiving, transparency of activities, the actual reporting, what is being reported, what is full, what is fair, what should participants in these funds actually be getting in terms of information, or even indeed in terms of selection opportunities within those sort of things. And as the reform of the pension funds moves ahead, some of these ideas which are in these resources might be relevant to be thought about or even be promoted within Ukraine by the CFA Society or other interested individuals that are invested within the industry. So I will be covering some of that. Starting, however, with GIPS, I would hope. There we go. Global Investment Performance Standards. Voluntary set of standards. They are global. We have over 40 different countries and regions which sponsor these standards, including country sponsor within the Ukraine. They govern the calculation and the presentation of ex-post performance to prospective clients. So what information are you presenting to prospective clients regarding your ability as a firm to manage assets? Voluntary standards. The aim of the Institute is to achieve universal demand for compliance with these standards by getting asset owners, those could be sovereign wealth fund, pension plans, endowments, foundations, any organization which owns assets, to demand compliance with these standards, adoption by asset managers worldwide, and support from regulators. Regulators, these are voluntary standards, so support is what is being looked for from the regulators. Encouragement within their industry that this is a playing field, a level of the playing field that they wish to support and see being adopted within their industry. The objectives of the whole concept behind global investment performance standards is accurate and consistent data. It's got to be accurate, it's got to be consistent, otherwise you're comparing garbage with garbage. There is no comparability if there is no consistency. We were looking, as the CFA Institute, for global acceptance of a standard. As I say, we now have over 40 countries which support the standard. We have over 1,800 firms that have notified the Institute they are complying with the standard. We have 24 out of the 25 largest global asset managers by assets under management that are complying with the standards, which represents roughly 60% of global assets managed, are being managed by firms that recognize and claim compliance with the GIPS standards for some part of their organization. So that's quite penetration, even though we're only looking at, say, at around 1,800 firms overall that have notified us. But that is coming from more than 45 different countries. We have sovereign wealth funds, asset owners, in excess of 5 asset owners that actually claim compliance with GIPS themselves. This is very relevant within the pension industry, because here are the owners of the assets, the sovereign wealth funds, who are actually saying, we want to structure the process that we follow internally ourselves according to these standards. because they see them as high ethical standards, the governance control, the consistency that it brings, and also they can then talk to the asset managers that they work with and say, we are following these standards, we would like you to follow these standards as well, so the information they are receiving is put together in a consistent fashion as well. It's self-regulation, not that we are an SRO, we're not, we're a private organization, membership-driven organization, but there is a range of regulation which is valuable throughout the industry, going from private regulation all the laws and regulations, and SROs are somewhere in the middle of it. But this is industry, self-regulation by the industry, accepting that ethical framework that is valuable to follow, ultimately for the benefit of society, ultimately for the benefit of investors. That's what it's all about. And then to get that into the pension reform idea, if you want to build trust within the pensioners, the people who ultimately are going to benefit from that system, they need to be able to see that there is transparency, consistency, a full and fair approach to what is going on. Only by building that trust will they then be willing to invest in that system. And that is what you're looking for in an ongoing process. So promoting investor interests and instilling investor confidence is key in the objectives. So in terms of GIPS, we have some fundamental ideas which need to be followed. To control the input data, garbage in means garbage out, so you've got to control the input data. You need some form of controls around calculation methodology, because there are different ways of doing these calculations. How does that make it comparable? What is the true track record? That we address within what's called composite construction. It's not just data, it's data and disclosure, because there are certain things that have to be described and cannot be done in any sort of data fashion. And then what do you present and how do you report it? So GIPS is broken up into those 5 basic concepts. The fundamental ideas are, I think, really quite important in terms of the pension reform idea. First and foremost, as I said, voluntary standards. And we have one provision within the standards that say, if you need to follow local laws and regulations which go against what GIPS will require, then just state why you deviate from GIPS as a disclosure, and you can still be in compliance with GIPS, and obviously you're in compliance with your local laws and regulations. Don't forget, it's a global standard. We can't write it in a way that accommodates deviations for the same ideas according to different countries. So we have that provision in there that allows for certain local deviations while enabling the firms to claim compliance. I want to make it absolutely clear that it is the firm, the asset manager, that would be claiming compliance with GIPS. Not for a specific product, not for a specific portfolio, not for a specific client, but it is an ethical framework that the firm says it is following and is conducting its business following that ethical framework around how they generate track record and how they present it to every prospective client. Once they're claiming compliance, they have to treat every single client in exactly the same way, prospective client in exactly the same way. This is not a standard addressing how you report to your existing clients. Hopefully, there is enough communication between existing clients and the firms that are managing their money so that those existing clients are getting the information that they need. This is about presenting track record to prospective clients. So if you had pensioners who are wondering where to allocate their assets in terms of their pension funds, hopefully, possibly, they would be receiving standardized information from the asset managers so that they can evaluate different managers against each other, knowing the basis upon which that presentation is generated is identical, because they're all claiming compliance with GIPS. So we'll go on. They're fundamental, but they're clear. You mustn't present false or misleading performance or performance-related information. That's not allowed. You claim compliance, you mustn't do that. These are high-level requirements. Very, very key here in order to make sure there is consistency and comparability and full and fair. Policies and procedures that are used to support the claim of compliance are documented, must be documented, and they're applied consistently. That is key. That is key. Not only is it key, it's very useful to the asset managers, but also to the asset owners in controlling and knowing how things are being controlled. Internally, when you've documented your policies and procedures, there's all sort of risk management, internal audit, business continuity ideas that flow out of that. And in terms of asset owners, knowing what is being done and how it is being done in advance. These policies and procedures are set in advance. So such and such happens, oh, we do that, and you do that consistently. They must be maintained and they must be applied consistently. As I said earlier, you must provide the same level of information to all prospective clients. You can't pick and choose who you present full and fair to. Everybody is treated the same. This isn't an all or nothing. You can't say, we are compliant with GIPS apart from we don't present what we're meant to. That's not acceptable. It's an all or nothing. You provide a list of everything that you have done, have managed in terms of its performance over the last 5 years. So people can see, as a firm, how you have done over time. That is also crucial. So in terms of input components, what needs to be monitored and managed to ensure that there is consistency? First, all the data and information that's necessary to support the claim of compliance has to be captured and maintained. That's not uncommon. Regulators usually require that sort of thing anyway, but that's key for GIPS as well. Valuation is done in accordance with fair value and the GIPS valuation principles. Those valuation principles are based on international standards. So we're not suggesting anything different from that. We're incorporating international standards into the requirements of GIPS. And then we start to get into a few details, and given that I have a limited amount of time, I'm not going to get into that, but the presentation is going to be available, so if you are interested in seeing those sort of details, you'll be able to see what happens. So in terms of fair value, it's the traditional descriptions of what is fair value. Now, it can be difficult where there are in marketplaces uncertain prices available, deviations, dispersions in prices and how you get them. However, for a firm that is claiming compliance with GIPS, it will have within its policies and procedures what is following in determining what is the fair value that they are using. Those processes need to be applied consistently. If you're following those processes consistently, over time, granted, not point in time, but over time, deviations, because there are deviations in prices that are available for the same security, will out over time. There may well be deviations at a point in time, but in a nutshell, arbitrage will get rid of those deviations in the pricing that is assumed, certainly in terms of realized gains and losses. So the valuation principles are laid out within the GIPS handbook, and they are typically following international standards. So I'm not going to dwell too long on those either. Other concepts that have to be maintained and supported and consistently. Existence and ownership of client assets. If you don't have that, you get Ponzi schemes. So it has that the assets being shown and indicated actually do exist. And the manager is claiming compliance with the fact that they do that. You have to document valuation policies and document your methodologies. You have to document hierarchy. You have to disclose policies for valuing are available upon request. The firm doesn't have to deliver those to every prospective client. However, where a prospective client is interested, then they can request that those policies and procedures are made available. More detail around valuation there. Now, in terms of calculation components, actually generating rates of return, the purpose of GIPS is to enable prospective clients to compare the returns of managers one to the other. So GIPS recommends the use of gross returns. So that's the value of the assets, excluding the transaction costs and excluding the investment management fees, the gross return. Now, some may say, well, why is that? That's not the return that the client can eat. That's just telling you what the manager is capable of doing. Okay, well, the whole point there is so you can compare manager to manager. Now, it may well be that regulation also requires net returns. So what is the owner of the assets going to get back in the end themselves that they can spend, a net return. But to actually compare the ability of managers to manage assets according to various strategies, it's the gross return that actually shows that. At the same time that you present gross return, you also have to supply the fee schedule that is relevant for that particular prospective client. So if you had institutional assets, you might have a different fee structure from high net worth or private client. So whoever the firm is presenting the information to, gross returns and the applicable fee schedule as well. The calculation has to be done monthly. I'll get into a little bit more when we get into the composite, why that matters. But a rate of return must be calculated at a minimum monthly, okay? Cash and cash equivalents must be included. It can't just be principal. It's got to include cash and cash equivalents. Their total returns. So there's potentially a drag because you have frictional cash when managing assets. That has to be included, not just the capital return. And as I said originally, it's minus the actual trading expenses. You can't avoid that. Okay, those expenses matter, but in terms of the return, you have to allow for the fact that the trading expenses are there. So what would be a real full and fair performance record for a manager's product? Is it their best performing portfolio? Well, they'd love to think it is, but obviously it's not. Okay. In order to be full and fair, you have to take all the portfolios which are being managed equivalently to that strategy, aggregate them together, and present that as the number. That is a composite. The way you do it practically is you just make sure that in advance, each portfolio, you know the strategy that it's meant to be following. And then what you do at the end of each month, when you generate a return for each of those portfolios, you put each one in a bucket. And that bucket mirrors the strategy that that portfolio is meant to be being managed to. That bucket is called a composite. By aggregating them all together, you're actually getting a weighted average for that manager's ability to manage that particular product. And it is that they show to the prospective client. In addition to that, there will be a dispersion for obvious reasons, such as cash flows. Certain portfolios will experience a different pattern of cash flows from other portfolios. That may cause there to be a little bit of volatility around that weighted average. So you also present the dispersion for that product. But it gives the recipients the full understanding of the manager's ability to manage that particular product, rather than a rep account. And we all know that rep accounts change over time, and then it becomes very much driven by the manager as to what they're showing. No cherry picking. It's the full and fair record. For a firm that is claiming compliance with GIPS, all the portfolios for the firm that is claiming compliance will be assigned to their respective composite. So say they've got 300 portfolios split across 10 different strategies that they manage, you will end up with 10 composites of a varying number of portfolios in them, generated each month, and that is the track record of that firm that is claiming compliance. That is the list that is going to be presented, those 10 different products, by that firm that is claiming compliance. Okay? they're actual assets. They're not models. You're not allowed to take tested information, model information, hypothetical, whatever, and add it to actual. This is actual assets and the results of actual assets. If you want to present models, that is called supplemental information. And that does have some validity, but you don't link hypothetical model with actual. We're just interested in how the managers have actually managed true, real assets. Portfolios change. Clients change the way they want their money managed. And so there is a mechanism for a portfolio to be, it stays in a composite until you're going to change the way it's going to be managed. Then there's a transition period, which again, there's a policy around how long that should take. And then it moves into the new strategy composite that it is now being managed under. So assets join and leave in a consistent way. If a portfolio mandate is lost by a manager, you don't strip out that information from the composite. It stays there. These things are generated on a month-by-month basis. What should be in there for a particular month is what stays there. If you happen to lose that portfolio, then you don't have it to assign any longer, but it stays where it was for the time that it was managed that way. No survivor bias. Obviously, where there is survivor bias, normally what's happening is the worst performing portfolios start to be removed from this aggregate performance, and you end up with the best performing portfolios being shown as the manager's record. That's not on. That's not on. Where assets join or leave, there's client documentation that supports the fact that this particular portfolio should be being managed in this way. So it's all tied back to the assets that are being received or being withdrawn from the manager. Historical stays where it is, as I just said, with survivor bias. So that's what a sort of track record is going to be built up from. What is the context in terms of other disclosures? You've got data in the previous one, disclosures. What is the universe? What is the definition of the firm that is actually claiming compliance with GIPS? I used to head performance for JP Morgan. We had 3 different entities claiming compliance with GIPS. All assets managed in the US, private client assets, all assets managed in London and the emerging markets. 3 clear definitions of the firm, understandable by the industry, what it is that was claiming compliance, and everything within one of those definitions was assigned and treated correctly. They were big definitions. The all assets managed in the US, about $750 billion, being assigned correctly according to the GIPS standards on a monthly basis. So a big commitment to following the GIPS standards, but as you will see, a lot of benefits from doing that. So the description of the product that is being shown, it's not just data, it's not just a name, this is a large cap equity product, it's a description which includes risk ideas as well as the investment ideas. You need to be describing the fees and the impact of the fees. You need to say what currency you're actually producing this information in. Deviation, I talked about dispersion within the composite. Lists of descriptions, policies are available upon request, as I mentioned earlier. There is a risk measure. Currently, our risk measure is kind of Mickey Mouse. It's a 3-year annualized standard deviation. It has to be presented for the product as well as for the product's benchmark. So it's not just in isolation. And you have to show that on a rolling 12-month period for every prior 3 years. It's relatively simple at the moment. But we mustn't forget, and I don't think this has been mentioned somewhat, return is not just down to what gains or losses you have made, but there's risk involved in gaining certain return. And to present any return numbers without some concept of the risk involved would be incorrect. There's really 3 parts that must be included in any presentation of a manager's ability. It's the return, it's the risk, and at what cost? What were the fees that enabled me to buy this product, and what risks were inherent within that product? And the GIPS standards address all of those things. In terms of presentation, am I just going to present the last 12 months? What is a full and fair presentation? Well, that's not the case. what you have to do in order to claim compliance is present the information about the particular product either since its inception or the prior 5 years. Okay, whichever is the shorter. It sounds odd, but that makes perfect sense. If you've only managed something for 2 years, you obviously can't present 5. You can present the 2 and still are able to claim compliance. If you've been managing for 7 years, you have to go back at least 5 years. Now, practically, if you're a firm that thinks, I really want to get into this, but to go back is going to be a disaster, fine. Start collecting the information now. In 5 years' time, you'll be able to claim compliance. But don't worry, there's still a huge amount of benefit in the collection of the data now that can be derived by the manager that is claiming compliance. So, minimum of 5 years. And then it builds to 10 years. And then the manager has the choice to continue to build on that for the particular product or just have it as a rolling 10 years, rolling every 12 months. So that gives you a really full idea of how the product is or has performed. Now, let's not con ourselves here. Past performance is no guarantee of future returns, and that is not why we do this. I know in the PRIPS discussions, which you may be aware of, and the UK regulator back in the early 2000s, they were adamant that past performance was at best useless and at worst misleading. Okay? But that is not what we're trying to do here. Past performance of a product presented against a relevant benchmark and comparable to all the other managers operating in that space offers a significant amount of information to the prospective client, indicating how a manager operated in that environment at that particular time and how that stacks up against all the other managers operating in that environment at that time. If you don't put controls around past performance, anything could be presented and be allowed to be got away with. Studies indicate the 2 most important things to a prospective client are brand and past performance, despite the fact that a lot of regulators say you must say past performance is no guarantee of future returns. But nonetheless, prospective clients latch onto that past performance. How much better that we should put some standardization and put some control around that so that that information is indeed not false or misleading, but is actually controlled and standardized and comparable. That is the need, that is the essence behind why GIPS exists. We are not saying that this is predictive of future returns. What we're saying is, in a consistent and comparable way, it describes what happened in those periods and can be compared to other managers who have also adopted the same standard. Let's move on. The policies and procedures. They are absolutely essential to implementing business controls at all stages of the investment performance process. A firm that doesn't have controls is on a recipe to disaster. So there are always going to be some controls, but what are they? Are they consistent? Are they comparable? What are they? In terms of GIPS, the firm must document those policies and procedures for everything that they have to do, and also the things that they optionally elect to do as well under GIPS. There has to be policies and procedures. They must be consistently applied, reviewed regularly, and not changed frequently, and certainly not retrospectively. How is it a policy, how is it a control if it's constantly being changed? Forget it. Yes, the industry changes. There'll be additional policies and procedures that are needed, additional controls, and you would just amend your policies and procedures over time to reflect these changes. It then becomes a history of how the firm is operating. Instead of people wondering, what on earth did we do in blah, blah, blah time, you go back to the policies and procedures. It's clear what was done. You make sure you're applying consistently the approach that you had the first time to the approach you have the next time. Very, very important. There are benefits to a firm having these anyway. Risk management, internal and external audit, client due diligence, existing clients, as well as prospective clients, existing clients, because you're using the actual portfolios that are being managed by the firm in the composite construction, that data is relevant to the owners of those portfolios. So existing client due diligence, business recovery, the actual firm memory, as I've said. It's the template for continuity. It eliminates the grey areas, eliminates indecision, it eliminates endless hours spent trying to reconcile one thing with another where actually they can't be reconciled. It reduces the contradiction, it reduces the areas. It actually takes everybody's concern about the data away, and they can actually concentrate on people, process, those sort of things, the value add that an asset manager can bring, rather than the asset managers get into a meeting and the prospective client immediately says, well, these numbers don't tie into the ones you presented 6 months ago. And then they spend 45 minutes trying to justify the data because they don't have a consistent approach in place for what they do. Eliminate all of that. Errors are eliminated because you've got policies and procedures. It is initially resource intensive, but think about what I've been talking about. There's nothing there that a firm that is trying to market its ability is not already doing. They've got to value stuff. They've got to generate performance. They're making some form of presentation. They're doing all of that stuff anyway, but they're doing it in a completely chaotic manner, or at best a unique manner, which has to be justified every time they see somebody. Or they can say, we're following GIPS. It's a global standard. It's been around for 20 years. There are 1,600 firms that follow it, plus, etc., etc. And they can be giving, if they want, a copy of these standards to their prospective clients or even their existing clients and say, let's help educate you on what this all means, what it's all about, why it's of value. Transparency of the process. Transparency has been mentioned in other presentations as well. It's key that people can understand what they're being shown and what they're being offered. Transparency. So relevance of GIPS to multiple stakeholders. For asset managers, we've kind of covered this. There are internal controls. Externally, they can be seen to be adhering to ethical best practice, not just what they must do, but what they actually believe in their business is best to do. It helps with the due diligence, the comparability. It's a non-proprietary approach. I've mentioned it. For asset owners, so the plan sponsors, the sovereign wealth funds, the endowments, it's great governance in terms of what's being done by the asset managers. Consistent policies and procedures and controls. They can be much more comfortable, build trust on the people they're doing business with. They themselves, the asset owners who are claiming compliance with GIPS, will benefit in exactly the way the asset managers do if they're following this sort of control structure around the plans that they own. From an asset owner's perspective, if they are claiming compliance internally, they can demand the same from the third parties and know exactly what it is the third parties are talking about if they're trying to pull the wool over their eyes. If they're saying, oh, it's too difficult, you really don't want this information, they know what it's about. And as I say, we have a number of significant asset owners claiming compliance with GIPS around the world. The Middle East, Scandinavia, the US, all claiming compliance with GIPS. So benefits there to asset owners, the pension plans, not just the asset managers. For consultants, it gets all that data dealt with. Now, obviously, they have to go in and do some sort of checks to make sure this firm is claiming compliance. Is that really true? Not so difficult to do some low-hanging fruit ideas to really make sure that they are. But when they're sure that they are, then they can focus on the other areas that a consultant can add value in terms of looking at asset managers or indeed looking at the plan sponsors. They add value from the analysis of the data, not having to find out if the data was actually constructed correctly. From a regulator's perspective, as I said at the start, private regulation, self-regulation is part of the continuum that helps an industry develop. It's an important tool in that continuum. Self-regulation can actually proceed faster in a lot of instances than rules, government-led regulation, just because you can get the people who are at the coalface involved and moving ahead with whatever it is that you're looking to build a control around. You can engage the subject matter experts more readily when it is self-regulation. And obviously it's of benefit to the industry to show itself to be holding itself to a higher standard. So I'll skip through this a little bit. I need to be aware of time. Yep. More benefits to asset owners. As I say, the presentation will be available electronically. These are the types of asset owners who should be finding interest within GIPS. And there are various benefits for asset owners who are acquiring people that they do business with to claim compliance, as well as asset owners who are actually claiming compliance themselves, as I've mentioned briefly. If you're not doing all of this, then what are you doing? And why are you deciding not to go with the global standard? Because it's not asking you to do anything in addition to what you're already doing. So there are some ideas. Cost is sometimes put forward as a reason why people wouldn't look at the standard, but particularly when an industry is developing or in a developing phase, you're making the decision, well, we are going to do this or we're going to do that. Undertaking GIPS is, I absolutely believe, not going to cost a firm any more than them independently having to work out what they're going to do and then put that into place. Because it's not asking a firm to do anything in terms of tasks any more than they would otherwise be doing. So there's that. And if anybody is concerned about GIPS, it's been supported by the CFA Institute since 1987. We have 10 full-time members of staff just concentrating on GIPS. It is a key part of our outreach to the asset management industry in general, advocacy, specifically ethics, professional conduct are key within the CFA Institute. Every single candidate and charter holder studies ethics and professional conduct in every level of the program. It is absolutely a key part of the Institute's existence and will continue to be so. So what else do we have? I said there are a few things that we might be able to supply as resources. GIPS is all about presenting to prospective clients. We also have some guidance around effective investment reporting to existing clients. What sort of reporting should existing clients be able to expect from an asset manager that is interested in supporting the investor? So we came up with principles of investment reporting and effective investment reporting. They are linked to, but not part of, the GIPS standards. GIPS is prospective, this is existing, okay? They are not telling people what they should do. They are guidelines for what effective investment reporting should look like. Very briefly, 5 principles. Communication must exist between the preparer of the report and the user. Why do they need it? Is that information in there? There needs to be controls. Client preferences should be in the report. It must be clear and transparent presentation, and there must be comprehensive fee disclosures. They buy this, it costs them something, do they get value for money? That really is what it is. Effective investment reporting is a number of different tasks that could be included under each of those principles. The recommendations to facilitate a dialogue. Now, this can be taken to different levels depending on the business model that you're following. If it's mass market communications, then maybe up front it said, this is the type of reporting you will get. If it's one-on-one communications, ultra-high net worth, or asset owners, you have a different level of support. But these ideas, these principles should be considered. That's part of the effective investment reporting. The preparer determines the client base to which they can offer this type of reporting. That's made clear, so people know what it is they're getting, depending on what it is they are potentially purchasing. So these are additional guidelines that may be useful in a developing industry to indicate maybe how it should think about growing and where it should go. Ultimately, for the benefit of the investor. That is key. helping to build trust. So we have those. Now we have the Asset Manager Code of Professional Conduct, another guideline which firms can actually commit to. So they can claim compliance with the Asset Manager Code of Conduct. They demonstrate their commitment to ethical conduct. This is in general, the way they run their business, not GIPS, not EIR, PIR, in general, and putting investors first by complying with AMC. It covers these sort of ideas, that the client's interests come first. Seems relatively straightforward, but there we are, it comes first. There's transparency, there's confidentiality, full and fair disclosure. You see how this sort of ties in with the details of GIPS, but is higher level for a firm. You avoid and you disclose conflicts of interest. There should be fair dealing. No one set of clients or one particular client or a fund versus an individual portfolio is treated any differently from any other. Reasonable care, prudent judgment, independence, objectivity, diligence, competence. It goes further into describing all of those things. It's a voluntary code, but firms that adopt it, and we have over 1,800 firms globally that have adopted this code, are really showing themselves to be dedicated to putting the investors' interests first. That's not to say they do it for free. Of course not. It's a business, but they're putting the investors' interests first, and they will be adhering to these concepts, okay? It's applicable to all firms, regardless of the size, from the single-person outfits to the global multinational firms. Typically, as we get into one area, I'll just look at trading. Within the AMC, in the trading section, inside information, best execution are brought out as code of conduct that need to be followed in specific ways. There are insider trading prohibitions that must be followed by a firm that's claiming compliance. Priority of client transactions over inside firm transactions. Soft dollars are used only for services that benefit the client. Different countries look at soft dollar issues in different ways. Best execution must be pursued. Fair and equitable trade allocation. So a firm that is claiming compliance with AMC is following these codes and has this code written into the way that they do business. This will enable somebody like a pension regulator to look at firms and say, oh, I see that they have a commitment to doing it in a certain way. Maybe you want to look at them in preference to somebody who has not voluntarily adopted this code. So that code's available to be looked at and considered. So I've been through a lot. GIPS, effective investment reporting and principles of investment reporting for existing clients, the Asset Manager Code. We also have guides for pension trustees. There's a pension trustee code of conduct. So for individuals who are members of trustee boards within pension plans, this is a voluntary code of conduct that they can adopt and take away, and maybe it sets a level for the pension reform that would be very useful to be followed. In addition, we have slightly more weighty tone, a primer for investment trustees. As pension plans develop, there will be employee members sitting on these pension plan boards, potentially. What do they do? What should they expect? Is the plan meeting the expectations? What should they have reported to them so they as a trustee can really make sure that the plan is delivering what it's meant to be delivering for the beneficiaries? So these are just guidelines and ideas and education that the Institute can share through the society or available through their website with anybody to help the discussions and to promote certain concepts as the pension reform marches ahead. A number of resources that are available. Everything's available electronically online. Dive in, enjoy it. You may get lost. And of course, my presentation is going to be available as well electronically. So thank you very much for your attention. And any questions?
Thank you for your presentation. A question related to the adoption of EIR or GIPS. Are there any minimum, well, given the relatively small size of the firms here locally, are there any minimum thresholds in terms of asset size, number of staff, in order for the firm to go ahead adopting this?
No, not at all. Not at all.
Right. And if a firm decides, or pension fund, board of trustees of the pension fund decides indeed to go ahead and adopt the PTCC, for example, or the GIPS, any guidance available from, I mean, how do you proceed? You seek advice from the Big Four locally, you go ahead asking the CFA Society Ukraine?
Yeah, I'm sure you can certainly ask CFA Society Ukraine, but there are many, many resources available, say on the GIPS website. We have a specific website just for GIPS. There's video, audio, presentations, all manner of information. We even have a help desk where questions can be sent, and roughly within 3 business days, a response comes back specific to that question. We have documents about assistance to firms considering implementation of GIPS. It's 24 pages. It's great. There is no shortcut to just reading the standards. The standards are roughly 80 pages in the 5 sections. Yes, I mean, I would say to anyone, if you're thinking about it, please read the standards. That's a good way to start, or a good way to fall asleep, one or the other. But also look at the implementation assistance, and then just go into the website. There is masses of information in there.
Clear. So no matter how small the firm is, how small the pension fund is, it still can go ahead and
if
consider
anything, the smaller, the easier it's going to be.
Right.
The less people you have to reach out to. Someone should become the subject matter expert within the organization.
Right.
That's key. And then go from there. But it does not matter. As I said, it can be a single person who manages a strategy, and as long as they have all the documentation to support what it is that they will present, and they follow the requirements of GIPS.
So to summarize, we can simply go ahead and seek advice from the CFA Institute.
You can do that. There are consultants out there who specialize in GIPS implementation, GIPS maintenance. We also do have a concept within GIPS of third-party verification.
I presume Big Four do that.
They do.
Okay.
And many others.
All right.
And many others. Just quickly, there is a CIPM designation, which the CFA Institute supports. Roughly 40% of the curriculum of CIPM is GIPS, somewhere between 25 and 40. If you're looking for a consultant and you think, do they know what they're doing? See, possibly, if they've got a CIPM in the staff. Question them about what it is. It's buyer beware when you're looking at consultants and verifiers. And in fact, we have a document that says, here are some things you should ask your verifier.
We should be looking for someone with CIPM designation after the names.
I'm not saying that's necessarily what you should concentrate on, but if they have that,
it's an advantage.
Then it's an indication that they've studied and know it's part of GIPS. Yes, I would say that.
Thank you very much.
You're very welcome.
Any more questions?
Ludmila.
Thank you for the presentation, Jan. Ukrainian Association of Investment Business, national country sponsor, who present here, had a meeting in November, and we decided that most asset managers in Ukraine are looking for more practical cases. What we have to disclose we have to find some practical cases, and we would like to organize some practical seminars to study these practical cases. What documents, what information we have to disclose. Where we have to find this information? I'm looking for these resources and I couldn't find this.
Okay. The website, because there is a huge amount of information, does have an awful lot of places where you have to look. A lot of the useful information is in the governance section. So you go to www.gipsstandards.org, which is our main area. At the bottom, there's a whole set of titles. look for governance under there. You will find all the guidance statements. You will find webcasts, webinars, presentations, white papers, all sorts of things down there. As I said earlier, there's no shortcut to really just having to read the information. In terms of disclosures, for instance, there is a disclosure matrix saying what disclosures need to be shown and for what periods. I am sure that we can coordinate some form of practical seminars around the details that make up, for instance, a compliant presentation. And we could just take an example of a compliant presentation, and there are many in the handbook or even in the standards, and just work through that. That might be a useful thing if you feel you have enough members who would be interested in that. Something we could plan as a additional outreach. Okay.
I think also it might be useful to look at the CFA curriculum and the past CFA exams, because they have the section on GIPS.
Yeah.
If you, by practical cases, you mean the example of this or that, investment performance is compliant or not, they have lots of cases there and explanations.
Yeah. And the implementation assistance document also has a case study from, I think it was a firm in Pakistan, which is part of that document as well. So it kind of helps lead people through the concept of a firm trying to claim compliance. So that might be useful as well. That document is also, I haven't got a link to it there, but if you search in the CFA Institute search box, assistance to firms, it'll come up immediately.
Your colleagues, do any more questions? Oh, that was easier. No, I just wanted to finalize, just say that we were listening to you with Ola, and we couldn't help checking that the total asset under management of all the GIPS compliance firms in the world that you mentioned is
Yes.
$46 trillion.
Yes.
So I think if these companies see it worth to claim GIPS compliance, I think that small Ukrainian pension funds just have to follow this trend, I would say. And I would just only, why would the CFA Society became so adamant about promoting GIPS in last year, I think, since our last GIPS event, because we started to hear about the pension reform, because this amount of pension funds that we have here, some of them are good, some maybe not, we don't even know that, so we think that it will be critical for them to apply some standards of investment performance if they want to manage this Pillar 2 pension money, because it's a public interest, because it's a mandatory money going into the system that people have no choice either to put this money there or not. So
yeah,
it will be critical.
Absolutely.
So thank you, Iain, for this. And
you're very welcome. And there are materials available outside on the table, or as I say, available electronically if you don't want to break your backs carrying it home. But there are some copies out there. Okay? Thank you very much.
Okay, thank you.